This is Richard Flax at Moneyfarm with a regular monthly update. The story for the third quarter has so far been very different from the first half of the year. After months of poor performance, July showed a strong recovery, particularly in equities. Global equities returned around 7% last month, their strongest performance since November 2020, following an 8% loss in June. Growth stocks generally outperformed value, and cyclicals generally did better than defensives. We've seen some re-rating in equities, but US equity valuations are still in line with their 5-year average. In other geographies, valuations remain cheap relative to their own history. We continue to debate whether July's recovery marked the start of a new positive trend in markets, or if it's just short-term volatility in an environment that remains challenging. From a long-term perspective, we can see that starting valuations are better than they have been, particularly outside the US. And that's an important consideration for long-term returns. At the same time, the immediate outlook is more cloudy, with ongoing concerns about growth and inflation, as well as geopolitical considerations. The tension between China and the US over Taiwan has risen sharply, even if financial markets have so far appeared quite relaxed. Recession is on everyone's mind at the moment. In the US, we've seen 2 quarters of declining growth, while in the UK, the Bank of England is now forecasting a fall in economic activity over the next year. While we've seen data weakening in both countries, the interesting point is around the labour market. Jobs remain plentiful, and employers are in many cases struggling to hire. The unemployment rate is still low, and wages are rising, albeit at a slower pace than inflation. At the same time, consumer confidence has weakened, and inflation is causing issues even for those with decent jobs. The upside is that there's some reason to think that inflation in the US should begin to slow. We've seen commodity prices begin to fall, along with shipping rates. That would be positive for financial assets and the real economy. In fairness, it's a consensus view that inflation should begin to decline, but it would still be reassuring to actually see that reflected in the numbers. Finally, let's have a look at the performance of listed companies. And here we can find some reason for optimism. July saw the latest earnings season in the US, with around 85% of the S&P 500 now having reported. There are a few key takeaways. First, results were generally decent. Around 3/4 of companies beat expectations, even if that's actually below the 5-year average. We've seen margins come under a little bit of pressure, but in general margins have been relatively well contained. As you might guess, energy and utility companies generally did best, at least compared to expectations. So when we think about the earnings picture in the US, we see decent results, still relatively strong corporate profitability, even if we've seen earnings expectations for the third quarter come down a little bit. We suspect that some of this strong performance in 2Q is a question of timing. We may see weaker results in the coming couple of quarters. We'd argue, however, that a lot of that is already reflected in stock prices. The global environment remains challenging at the macro level, but also for many households. Central banks look set to continue to raise interest rates in an effort to bring down inflation. They'll likely succeed, but at the cost of slower growth. We believe that inflation, notably in the US, will start to slow in the coming months. And the sooner we see that, the better for the global economy and financial markets. Thank you for listening, and look forward to speaking to you again soon.